Hello again, everybody. Welcome to OWA Live. Lynn B. Thurgood here with Oxford Wealth Advisors, and I'm joined by Gage Kemsley. Say hello.
Hello.
Anyway, we're glad to have a chat with you here toward the end of this 2020. Woo! What a crazy year. COVID, economic upheaval, racial tensions, wildfires, hurricanes, presidential election, electorate is polarized. And what else can we add to this crazy year? Can we just push a reset button? Would that be a good idea? And say do-over? Oh, I don't know. Anyway, listen, we've had a strong economic recovery in spite of all of this stuff. We got record low interest rates. The Federal Reserve has been propping up the markets and kind of helped that sell-off that occurred in March and April. Where do we go from here? What's in store for the next 4 years? One thing that we want everybody to understand is that nobody's got a crystal ball. And if we try to time the market based on political persuasions, that may not be the smartest thing to do. What we do know is the market has always had historically an upward trend. Now, we employ active management, tactical strategies for market-related money. So we try to hedge the bet a little bit there, but in the long term, we need to understand some of those fundamentals. Understand this is very interesting. Since 1932, the S&P 500 index, since 1932, up 710% under a Democratic presidency. Since 1932, S&P 500 up 375% under a Republican presidency. Maybe that caught you a little off guard. It did me. But the timing the market is the thing we have to be careful about, regardless of presidency. Had we just stayed put in the market in 1932, regardless of politics, we would have been up 47,000%. So again, upward trends, regardless of who's running it, just be aware of that. Now, if we look at the last 12 years, a pattern has emerged that those who pulled out of stocks in 2008 because they were discouraged by the results or worried, lost out on a significant rally that occurred thereafter. And so be careful about this short-term stuff. Long-term perspective is what we want to focus on. All right, with that in mind, what do we do? Is there anything we can do in the next month and a half to help your finances? Gage, take it away.
I can't believe we only have 6 weeks left before the end of 2020. In some ways, it feels like this year's been 20 years long, and some ways a blink and it's already done. It's crazy.
Yeah.
Here are our 7 financial steps to take in 2020 as we move into 2021. So first and foremost, we need to be paying attention to healthcare open enrollment. Healthcare open enrollment started now, and it goes through December 15th. So for individuals that are looking for health insurance plans to make adjustments or changes, this goes for anyone who's employed as well. You can make adjustments to those healthcare plans right now. You have until December 15th to get that done.
All right. Of course, the Medicare open enrollment is ongoing through December 7. If you haven't seen a Medicare commercial, I don't know what channel you're watching. Between the political commercials and the Medicare commercials, it's like, oh my gosh. Can we get it over with already? So get that Medicare updated. December 7 is the cutoff.
The next big thing that we're suggesting to everyone is to max out those retirement account contributions. So if you're under 50, you can contribute up to $6,000 into your IRA or to your Roth. If you're over 50, you can contribute up to $7,000. Also look to do whatever you can to make that contribution before tax day. Now, we didn't put what tax day looks like next year because this year they pushed it all the way to July 15th. Who knows what it'll look like next year? But you can make that contribution until you file your taxes into 2021 and have it be effective for 2020. One thing that is calendar date sensitive is your ERISA sponsored contributions, your 401ks, your 403bs. Be sure to max those out as much as you can. $19,500 for those under 50, $26,000 for those over 50. And again, December 31st is the cutoff there. So shove as much money as you can into those retirement accounts.
All right, the RMD. Most of you should be aware that because of the CARES Act related to the COVID crisis and other things, no RMDs are required this year for your retirement account or an inherited retirement account in the year 2020. So if you didn't know that and you do them toward the end of the year, be aware that you don't have to do that in 2020. And if you already did it, then it's kind of a mess. So, oh well.
Now, here's kind of a fun discussion we can have dovetailing into RMDs. I know that they're not required this year, but there are these things out there called qualified charitable distributions, to where you can take that distribution tax-free and send it to a charity. Certain individuals are eligible to contribute up to $100,000 from their IRA to a charitable institution. Now, some of us may be thinking, man, who in the world is going to contribute that much? Well, if you make charitable contributions at any point during the year, this might be a good opportunity to make that tax-free. Specifically to those of you who donate to churches, those of you who tithe, this might be a very effective strategy so that you're not paying taxes on any of these distributions, and the organization that you're donating to is not paying taxes on any receipt of those deposits. So up to $100,000 this year. That QCD also will meet required minimum distribution requirements. So keep that in the back of your mind for next year or oncoming years if you have those RMD payments that are necessary.
Yeah, what a great idea to get an RMD tax-free. I mean, that's the whole purpose of the RMD from the IRS, is to get taxes out of us. So this is a great wrinkle. All right, harvest tax losses. Every year, last quarter of every year, if you have any brokerage, stock, investment type accounts, you want to have a tax loss harvesting discussion with your financial advisor. Some of you may have a proactive CPA that does taxes that will have that chat with you. You got to get it done before the end of the year. It's too late after the fact when you're doing your taxes in February, March, or April to say, oh, well, I had some losses last year. Can I write those off? No, you have to get those done in that calendar year so that we can have that in your benefit to offset some taxes on some gains. Enough said there.
The last thing that we're going to suggest everyone should do this year is to consider converting from a traditional IRA to a Roth IRA. Now, if you've talked to any of us in the office, we probably have already talked to you about this. This is an incredibly important piece to a retirement plan. We think at the very least you should work to maximize your tax bracket, convert over traditional assets into tax-free Roth assets. Anyone can do this. There's no age limit, there's no income limit, there's no requirement to be working. The only key to keep in mind is that you have to have that conversion happen by December 31st if you want it to count for the year. Unlike your contributions, a conversion has to be done within the calendar year for it to count. So we hope that this is helpful. Reach out to us and let us know if there's any way that we can help you. If you need information on healthcare or Medicare, let's get you connected with Nicole or with another Medicare specialist in your area. Let's make sure that we're talking about tax loss harvesting. Let's talk about traditional IRA to Roth IRA conversions. All of these pieces are pieces that we can use so that we maximize our financial benefit in 2020 and enter 2021 with good financial prosperity. We wish you all the best. Happy holidays, happy Thanksgiving, Merry Christmas, and have a safe and happy year. Stay healthy, and we'll talk to you soon.
Stay healthy, wash, sanitize. Bye.